Welcome to Home Buying 101. Check out the playlist attached to this video and follow along if you ever want to buy a house in the future. Today we're going over the basics of what each different loan type allows you to have as far as your debt to income ratio goes and your minimum credit score. If you've bought a home in the past or already started the conversation with a lender, this may explain why your lender recommended a specific loan type just for you. I'll do videos on each individual loan type, but this is a general overview. Starting off with conventional. Conventional loans weigh your credit score really heavily, but technically you can have a score at or slightly below 620. In order to get your loan approved through the AUS system or the automated underwriting system, you are going to need to have a very substantial down payment if your credit score is in the low 600s. You are allowed to have up to a 50% debt to income ratio with a conventional loan. That means you can spend up to 50% of your total gross monthly income on your housing payment and your other debts. Next up is FHA. FHA allows you to have a credit score as low as 500 if you put 10% down. But most people put 3.5% down, and that requires a minimum credit score of at least 580. FHA actually has two variables to the debt to income ratio allowance. A front end, which is just strictly your total housing payment, and a back end, which is your total DTI, which includes your total housing payment. For FHA, you're allowed to spend up to 46.99% on your total house payment, but you're allowed to spend up to 56.99% on that total house payment and your other debt payments. The pricing for FHA loans isn't as dramatically impacted by your credit score. Now, VA loans do not have a debt to income ratio allowance, and they do not have a minimum credit score requirement. And if a lender tells you that they do, they are either wrong or they work for a company that has very strict overlays. VA approvals are based on a variety of different factors. And just because there is no minimum credit score requirement and no max DTI allowance does not mean that you can have really bad credit and still get approved. Approvals are based on your residual income and your payment history. USDA is similar. They actually do not have a minimum credit score requirement, and the max DTI allowed for a USDA loan is gray. Similar to FHA, USDA has a front end allowance and a back end allowance. The front end allowance, I have never seen anybody get approved beyond 34% for their total housing payment. But the back end kind of depends on what the system allows. In most cases, you're going to cap out around 44, 46%. USDA is really sensitive about credit and credit history. So even though there's no minimum, it doesn't mean, again, that you can have really bad credit. Next few Home Buying 101 videos will be each individual different loan type.